Hello there, Kaushik here from Tanashvi. So this is part three of our series on should I stop my SIP. This time we will look at yet another time period. So this is Nifty 500 TRI from February 2000 to February 2004. Now February 2000 is an interesting month because preceding February 2000 there was a 2-year bull run which resulted in a massive jump of Nifty 500 TRI. This was basically because of the dot-com boom in the US markets, and obviously the effects were felt in global markets as well, including India. Remember, our IT companies had just about spent about a decade providing services globally. After February 2000, the market came back to that level only after 4 years. In the middle, the market went down, went sideways, then finally recovered. So this is an interesting period where we can see if we continue to do SIP as per our rules, how do they actually turn out? So we will just stick to three portfolios this time: the conservative, moderate, and aggressive. Uh, just to recap, portfolios are constituted in line with the risk profile of the investor. Risk profiling is mandatory nowadays. The mutual fund distributor as well as the investor have to maintain records of the risk profile. Uh, there are three kinds of risk profile: conservative, moderate, and aggressive. The asset allocation is a mix of debt, equity, and gold in varying proportions. Uh, the highest percentage of debt is in conservative, the highest percentage of equity is in aggressive, and moderate strikes a balance between both conservative as well as aggressive. Now, why risk profile? Why asset allocation as per risk profile? There is an old episode of ours which talks about that, and we are thinking that we will bring out a fresh episode on this entire concept of risk profiling and asset allocation as well. Okay, so now let's look at the returns on the screen. So starting from February 2000, within a year, the conservative portfolio was still positive, but both moderate and aggressive portfolios had delivered negative returns. They continued to deliver negative returns even after 2 years of there was a CAGR returns. And by the end of third year, they had barely managed to stay in positive territory on a 3-year CAGR basis. But look at what happened at the end of 4 years. We had remarkable returns in both moderate and aggressive portfolios. And in fact, given the fact that the government was, RBI was cutting rates aggressively during this period, 7.77% CAGR in a conservative portfolio was very, very good, actually. So it just shows that markets behave like this. They go through periods of decline, then consolidation, which in common parlance is got sideways, and then finally again starts on a fresh bull run. So if we have to benefit from that, from market cycles, we have to be in the market. We cannot exit the market. Okay. And I mean, investment is not like I invest today and I can get my return 1 year later. No. Investment is exactly like agriculture. You plant a sapling of mango. It will take a minimum of 5 years before it can even start giving fruit. And I mean, you cannot pull the plant up to make it bigger, right? The same logic holds in investing. You can't force the market to give you returns. You have to be in the market, you have to follow some rules, and the market will reward you in its own time, not in our time. So that's why people say stay invested. Lastly, these are our disclaimers for mutual fund investments. If you have liked this three-part series, then please like, subscribe, and share.